Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. Markets are driven by a variety of factors, influences, and starting points, and these are often divided into two camps, the macro and the micro, or as they are sometimes referred to, top-down and bottom-up. Different groups of investors and traders on Wall Street approach the market from opposite ends of this spectrum. Strategists, economists, and asset allocators tend to focus on the macro, that is, big picture data, which can affect an economy, marketplace, or sector. For example, a change in the value of currency and levels of taxation, interest rates, and inflation. Whilst fund managers, and particularly those running actively managed funds, often look at the micro, that is, viewing things from the bottom up. For example, by looking at the merits of individual stocks that they believe can outperform the market. The interplay between the macro and the micro and the flow of funds that they create help to drive price changes in financial instruments. It's said that it takes two views to make or move a market, and that's often what you get when the macro and the micro meet, or when momentum in the market swings from one viewpoint to the other. We saw that last week with the release of the latest set of Federal Reserve minutes, which detailed the thoughts of the members of the FOMC, or Federal Open Market Committee, whose 12 members meet throughout the year to debate and decide monetary policy in the USA. In plain English, that means the level of interest rates and the amount of support and stimulus that the central bank provides to the market. The minutes of the FOMC meetings are released several weeks after decisions on interest rates and quantitative easing are announced, but they provide Fed watchers with a chance to get into the heads of the bank governors and perhaps to get a handle on how they view the future. Quantitative easing, or QE, under which the central bank prints fresh cash to buy government bonds and other assets in the market, is an unconventional monetary policy tool. An emergency measure that's really only meant to be used in a crisis and therefore not for the long term. So it shouldn't have been too much of a surprise that the minutes from July's FOMC meeting showed that the committee members were thinking about winding down or tapering asset purchases, which are currently running at around $120 billion per month. Goldman Sachs and other banks had previously set out a likely timetable for this policy change, suggesting an explicit mention of tapering at the Fed's September meeting, with the central bank likely to reduce its asset purchase from December this year. However, the markets were unnerved by the minutes of the July meeting, in the clear case of the macro pushing aside the micro. This chart summarizes why the prospect of a change in monetary policy caused a mini panic. It plots the expansion of the Federal Reserve's balance sheet in blue and overlays that with the performance of the NASDAQ 100 in black. Put bluntly, the more money that the Fed has printed and bought assets with, the higher the NASDAQ 100 has climbed. So what will happen if the Fed slows and then eventually stops its asset buying program? Well, we can look back into recent history for some pointers about just that, because the Fed has been here before, back in 2013 in fact. The then Fed chair, Ben Bernanke, first explicitly mentioned tapering QE in his testimony to Congress in May 2013. However, it took 7 months for the Fed to start to tighten its purse strings, reducing its asset purchase by $10 billion per month in December that year. Markets reacted negatively to Ben Bernanke's comments on tapering, creating what became known as the taper tantrum. The S&P fell 5% in the space of just 5 trading days. Interestingly, by the end of 2013, those losses had been completely erased and were little more than a distant memory. Being able to look back to the events of 2013 also provides us with a chance to look at how different types of stock performed as tapering became a reality. This chart from Bank of America looks at the performance of stock types or factors during the 2013 taper tantrum. All of these equity factors sold off, but value stocks performed the best, selling off by just 5.1% between the 21st of May 2013 and the 24th of June, compared to a loss of 7.2% in growth stocks over that period, and a drop of 5.2% in an equally weighted version of the S&P 500 over those 4 weeks. Within the value stock universe, those stocks that had a low forward price-earnings ratio and/or a low price-to-sales multiple fared even better, falling by just 3.3% and 4.3% respectively, according to the Bank of America data. However, it was growth stocks that outperformed across the balance of 2013, as the market became comfortable with the idea that the Fed was going to take its foot off the gas. With Fed Chair Jerome Powell scheduled to speak at the annual Jackson Hole Symposium, might history repeat itself once more? That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.